What happens when a retail giant, once a household name, loses its grip on the market and fades into obscurity? The story of Sears is a cautionary tale about missed opportunities, changing consumer preferences, and the relentless march of technology. At its peak, Sears was more than just a store. It was an institution. Founded in 1893 by Richard Sears and Alva Roebuck, the company began as a mail-order catalog business, revolutionizing how Americans shopped. By the early 20th century, Sears had expanded into brick-and-mortar stores, offering an extensive range of products from clothing to home appliances. It became synonymous with the American shopping experience, boasting a catalog that reached millions of homes. However, as the 20th century progressed, the retail landscape began to shift dramatically. The rise of suburban shopping malls in the 1960s and 70s provided consumers with a new shopping experience, one that was more convenient and offered a wider variety of brands. Sears, despite its stronghold in the market, failed to adapt quickly to these changes. The company was slow to innovate, clinging to its traditional business model while competitors like Walmart and Target embraced the new retail environment. This reluctance to change would prove to be one of Sears' most significant missteps. As the competition intensified, Sears tried to diversify its offerings. The acquisition of Kmart in 2005 was intended to bolster its market position, but instead it became a symbol of the company's struggles. The merger was fraught with challenges, as the two brands had different corporate cultures and operational strategies. Instead of creating a formidable retail powerhouse, it diluted Sears' identity and further complicated its operations. The integration process was poorly executed, leading to confusion among consumers and a lack of coherent branding. What was once a clear and powerful brand became muddled, losing its unique appeal in the eyes of shoppers. In addition to its operational challenges, Sears faced a fundamental shift in consumer behavior. The rise of e-commerce fundamentally changed how people shopped. Companies like Amazon began to dominate the retail space, offering convenience, vast product selections, and competitive pricing. Sears, with its outdated infrastructure and slow adaptation to digital trends, found itself at a significant disadvantage. While competitors invested heavily in technology and online platforms, Sears struggled to develop a robust e-commerce strategy. Its website was often criticized for being clunky and difficult to navigate, leading to a frustrating experience for potential customers. As more consumers turned to online shopping, Sears' brick-and-mortar stores saw a decline in foot traffic, leading to decreased sales and revenue. The financial strain from declining sales only exacerbated Sears' problems. The company began closing stores in an attempt to cut costs, but this strategy only further alienated loyal customers. Once a staple in many communities, Sears became synonymous with going out of business. The closures created a perception of decline, making it difficult for the brand to attract new customers or retain existing ones. The once bustling stores that had served as community hubs now stood empty, a stark reminder of what had been lost. Another significant challenge for Sears was its failure to invest in its brand. While competitors innovated and refreshed their marketing strategies, Sears remained stagnant. The company's advertising campaigns failed to resonate with younger consumers, who were increasingly drawn to brands that aligned with their values and lifestyles. Sears' image became outdated, and it struggled to connect with a new generation of shoppers. The lack of effective branding and marketing left Sears in a precarious position, unable to compete for attention in a crowded marketplace. As the years went on, the company's financial woes deepened. By the time Eddie Lampert, a hedge fund manager, took control of Sears in 2004, the company was already in decline. Lampert's approach focused on cost-cutting and asset liquidation rather than revitalizing the brand. While he made some strategic moves, such as selling off valuable real estate, these decisions ultimately failed to address the underlying issues plaguing the company. The emphasis on short-term financial gains rather than long-term growth strategies led to further deterioration of the brand's reputation and market position. Sears filed for bankruptcy in 2018, marking the end of an era. The once mighty retail empire, which had dominated the landscape for over a century, was now a shadow of its former self. The decline of Sears serves as a poignant reminder of the importance of adaptability in the ever-evolving world of retail. Companies must be willing to embrace change, invest in innovation, and prioritize the customer experience. Failure to do so can lead to a rapid decline as seen in the case of Sears. There are several key lessons that business leaders and decision-makers can glean from Sears' journey. First and foremost, staying attuned to market trends and consumer preferences is crucial. In a rapidly changing environment, businesses must be agile and willing to pivot when necessary. This means investing in research and development, exploring new technologies, and understanding the evolving needs of customers. Additionally, companies must recognize the importance of branding and marketing. A strong brand identity can create lasting connections with consumers, while a failure to engage with target audiences can lead to irrelevance. In a world where consumers are bombarded with choices, standing out is essential. Lastly, the story of Sears highlights the significance of digital transformation. As e-commerce continues to reshape the retail landscape, businesses must prioritize their online presence and invest in technology that enhances the customer experience. Those that resist change may find themselves left behind as competitors forge ahead. In conclusion, the decline of Sears is a multifaceted tale marked by missed opportunities, mismanagement, and an inability to adapt to a changing marketplace. As we reflect on this narrative, it serves as a reminder that even the most successful companies can falter if they fail to innovate and evolve. The lessons learned from Sears' journey are vital for businesses seeking to thrive in an increasingly competitive and digital world.